Ladies and gentlemen, good day and welcome to the India Shelter Q2 FY2025 earnings conference call hosted by ICICI Securities. As a reminder, all participants' lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on a touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Renish Bhuva. Thank you and over to you, sir.
Welcome to India Shelter Q2 FY25 earnings call. On behalf of ICICI Securities, I would like to thank India Shelter management team for giving us the opportunity to host this call. Today we have with us the entire top management team of India Shelter, represented by Mr. Rupinder Singh, MD and CEO, Mr. Ashish Gupta, CFO, and Mr. Rahul Rajagopalan, Head Investor Relations. I will now hand over the call to Mr. Rupinder for opening remarks and then we'll open the floor for Q&A. Over to you, sir.
Yeah, thank you, Renish. Very good evening, everyone. On behalf of the company, I extend a warm welcome to all of you. Thank you for joining us on the call today. We delivered another quarter of consistent performance with sustainable growth in our AUM. The continued performance in this quarter is on the back of improved volume growth, stable productivity, sustained margins, stable credit cost, and improved return ratios. Let me start with some broad macro updates. We see demand and growth potential is there in Tier 2 and Tier 3 cities. Government policies are supporting. New Pradhan Mantri Awas Yojana scheme will help in maintaining the growth momentum in future also. Calibration made in interest subsidy scheme with this regard to the payment of subsidy over 5 years will help in a better retention of quality customers. On the other hand, in case of balance transfer, such beneficiary will not be eligible to claim the benefits of interest subsidy scheme if it moves from one bank to the bank. Further details on the scheme is expected shortly, in a month or so. Though we are not directly exposed, we are hearing that stress is building up an unsecured lending market. We are keeping our eyes and ears on ground and monitoring the situation carefully. At overall portfolio level, we do track the trade lines of our customers. Our predictive risk models are helping us in elevating the collection efforts well in time wherever it is required. In our portfolio, DPD 30 plus have now stabilized around 3.5 to 3.6%. We expect to remain around this level in quarter 3 before seeing reduction in quarter 4. Rise in delinquency is limited to few geographies like Madhya Pradesh in our case. Issues were internal led to our manpower. We have strengthened our team in these areas and results are expected to kick off in next 3 to 5 months. On liquidity side, we are comfortable placed given the recent equity raise and rating upgrade. However, given the overall liquidity position in market, we feel that interest rates will remain elevated for some more time before seeing some softening as we reach 2025. There are some regulatory punitive measures for NBFC sector in recent time, but we feel that may be good for long term as it will make the NBFC sector more stronger and resilient to face macro headwinds, if any, in coming times. We have a strong governance, risk and compliance team to make sure that business is compliant with regulatory expectations. Moving on to the operational highlights, our AUM crossed 7,000 crores. We have 93,500 plus customer on book. We continue to source internally with in-house sourcing of 98%. 100% of our book is secured with only 2 products, which is home loan and loan against property. Basis our conservative approach, LTV on the book remains 52%. 90% of our AUM is from Tier 2 and Tier 3 cities. 78% of our fresh disbursements are towards self-employed customers. Moving to the results for the quarter, we are pleased to report an AUM growth of 36% year-on-year to rupees 7,039 crores, supported by disbursement growth of 30% year-on-year to rupees 828 crores. As discussed during the previous call, we plan to add 40 to 42 branches during the year On that note, we have added 24 branches during this quarter. We opened 6 branches in Maharashtra, 4 in Chhattisgarh, 4 in Rajasthan, 4 in South, and 1 branch across other states. Majority of a branch opening was done in first half of the year, as this helped us to achieve a break-even levels by the end of the year and operating leverage start kicking in soon. On profitability metrics, PAT came in at rupees 90 crores, registering a growth of 50% year-on-year. Return on equity improves to 14.8% from 14.3% in quarter 1 financial year 25. We continue to maintain our guidance, what we indicated during our previous calls. That is, branch addition of around 40-42 for the year, for which we have already opened 37 in first half of the year. Maintain margins at around 6%, credit cost of around 40 bps, and loan growth of around 30-35%. Now I would like to hand over call to Mr. Ashish Gupta, our CFO, to take you through the financial metrics.
Thanks, Rupinder-ji. Good evening, friends. Let me take you through the key financial numbers. AUM as on September 24 is at 7,039 crore. Year-on-year growth in AUM is 36%. Quarter-on-quarter AUM growth is at 8%. Total income for quarter is up by 35% year-on-year, driven by growth in AUM. Quarter-on-quarter total income is up by 9%. Portfolio yield is at 14.9%. Year-on-year up by 20 basis points. Our disbursement yield for H1 is at 15%. Our cost of fund is stable at 8.8%. Our marginal cost of funds for H1 is at 8.9%. We have undrawn sanction of 450 crore from National Housing Bank, which we are planning to draw in H2. Same will help us to improve the proportion of NHB funding in our borrowing mix. During the quarter, we have got a rating upgrade from ICRA. Now we have AA- rating from all the 3 rating agencies that we have. Our lending margins are consistently above 6%, in line with our guidance for medium term. Our year-on-year growth in OPEX is lower than the growth in AUM, resulting in better cost ratios. OPEX to AUM for the quarter is at 4.4%, down by 20 bips year-on-year. Cost to income for the quarter is at 37%, down by 340 basis points year-on-year. Credit cost for the quarter is 50 basis points, which is broadly in line with our guidance. DPD 30 is at 3.6%. Stage 3 assets are at 1.2%. Marginally up by 10 basis points as compared to the last quarter. PCR for stage 3 asset is stable at 25%. Our total ECL is 56 crore as against the regulatory threshold of 34 crore. Thus, we have adequate buffers are in place. PAT for the quarter is 90 crore, year-on-year up by 50%, quarter-on-quarter up by 8%. ROA for the quarter is 5.6%. It is stable quarter-on-quarter basis. ROE for the quarter is 14.8% at the leverage of 2.7 times. It is up by 50 basis points quarter-on-quarter. With this, I conclude, and now we can open the floor for Q&A.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Raghav Garg from Ambit Capital. Please go ahead.
Hey, hi, Rupinder and team. My first question is on NPA. I think you partly answered. There was some trouble in Madhya Pradesh, if I heard it correctly. Can you elaborate a little bit more on that as to what exactly was the issue? I think you highlighted something around manpower.
So there was a transition change which happened in that particular geography. We had divided our geographies into 6 various zones. Depend upon the size team, that way the zones has been created, which has been who these 6 zones takes care of these 15 states which we are operating around. So Madhya Pradesh is one of that state. We saw attrition which happened around a year back, and I think some impact because we couldn't find a right side of leadership, and the collection implications also happened because of some senior folks moving out and some branches not meeting the expectations number on that piece. And that way there was some bulge around, because of which now we have taken a corrective action, and we had a senior leader along with some quite a few senior folks who are having a good understanding of collection piece, as well as a few people from internally getting moved internally who will going to take care about this piece. So now thing is, any course correction which you take, that takes 3 to 6 months of time. This is something which was expected. What we try to stabilize this number to 3.5, 3.6%, which we are able to do, 30 DPT, that is the one piece in month of September. Now it's going forward how to take it back to the same place where we want to basically. That's the point that we're working around that side.
So out of this, I think as per my estimate, your net slippage for the quarter was around 14 crores. How much of this was because of Madhya Pradesh or whatever this transitioning problem that you've seen? How much would it have contributed to this 14 crores?
So I think 60 to 70% comes from there.
Okay. So ideally, adjusting for this, the net slippages have reduced, and that's what I think you're referring to, that by Q4 things should be back to normal.
Yes, that's a prerogative. We as we put the operation set properly, there's always challenges when you work in market about the portfolio, teams, people around, and that when we get it, and I think we are quick to understand, course correct it, and whatever these implications have come to, I think we are confident to take it up on time and would be able to manage it out.
And your securitization margins seem to be pretty high, compared to the peers. Is it because that you securitize a lot more of the non-housing loans, or is there some other reason to that?
Yes, you are correct. So we do securitize only non-housing loans, wherein the yields are in the tune of around 15.5%, and our cost of fund is close to 9%. So we are getting around 6.5% kind of yield, which we are affronting. So, but that is if you look at year-on-year basis, quarter-on-quarter basis, those margins are broadly stable.
Understood. And just last question, the cost of funds is still flat, right? I mean, generally, we've been hearing from you that there should be a 20-25 bits benefit because of the rating upgrade. So, that and then cost of funds still being flat, how should one look at it? How should we model cost of funds going forward?
So, like Raghav said, earlier we have assumed that the market rate are going to remain stable. But if you look at the trend of MCLR of the few of the large banks, you will see that in last 12 month kind of time, banks have increased their MCLR by around 40 to 50 basis points. So that is offsetting the benefit that we are getting because of our rating upgrade. And in fact, our rating upgrade from ICRA has just came in the month of August. So technically, we have got a full rating upgrade from all the 3 rating agencies now. So I believe that by the end of the year, we should be able to see about 10-15 basis points cut in the overall cost of fund.
Thank you, and that's all from my side. Thank you.
Thank you. The next question is from the line of Varun, company Kotak Securities. Please go ahead.
My question was regarding the fee income. It appears to be a little high this quarter. Is this going to be the normalized on that, or do we see it normalizing to a different level? And the next one is on the assignment income. So is there any hike in volumes, or is it just this is what we can expect going forward?
Sure. So on the DA income, the hike is broadly in line with growth in our AUM. So if you see, so in fact, if you look at our DA percentages as a percentage of total AUM, that is broadly, similar at around 16% year-on-year, quarter-on-quarter basis. So there is no change in the overall volume. The growth is just with respect to the business growth, only. Secondly, coming back to the your question on the growth in the fee income, there are two key drivers for that. One is the co-lending. So in this co-lending business, we have a 100% share in the fee income. So whatever processing fees that is coming from this business, we are 100% retaining that. So co-lending at this point of time is around 6% of our total disbursement. So that is helping us getting better fee income year-on-year basis as the volumes are picking up. Secondly, we have got our corporate agency in the mid of this H1. That is also helping us getting some better fee income. And we believe these numbers are sustainable from here.
Okay. So that 6% is on disbursements or on AUM right now? The share of co-lending.
Share of co-lending is 6% is on disbursement, and at AUM it is at around 3.4%.
Okay. Got it. Thanks. Those are my questions.
Participants, anyone who wishes to ask a question may press star and 1. The next question is from the line of Aditya Pal from MSA Capital Partners. Please go ahead.
Hello, am I audible?
Yes, sir, you are audible.
For the opportunity, congratulations to the team on the good set of numbers. So I am a bit new to the company and wanted to understand the unit economics of a branch. If you can quickly explain when does a branch break even, at what AUM, what is the OPEX of a mature branch, and how long does it take for a branch to mature? And I see that you're presenting more than 3 years. So at more than 3 years vintage, what will be the OPEX per branch, OPEX to AUM of a branch? If you can quickly help me explain that.
So any branch when we open, we generally have a set of team, which is bare minimum team which is required to set up a branch. So normally a branch manager with 3 to 4 loan officers, supported by credit manager, as well as branch operation executive, what we call operation manager or customer service manager. So these are the bare minimum people, set of people who start the branch, we open it in any of the geography. So as branch grows, there is the addition of the people in terms of business team, as well as once it reaches a certain level, there is the addition of people in terms of collection team. If branch is large, there is also addition in terms of a technical manager. Having said so, if there is a new branch and there are a couple of branches around him which are also equally new or small, then there is some sharing of resources in terms of technical manager or legal manager. This is the basic structure of any branch works. We have observed branch break-even comes anywhere between 8 to 9 months from the start of a branch. So OPEX of any branch is around 25 lakh rupees annually, which we spend. That's on average. Somewhere it will be a little low, somewhere it will be more, depending upon size, location, geography, rentals, and things around that piece. So 8 to 9 months, branch starts getting break-even. So we have divided a 3 category. The first category of the branch, in the first year of operation, they disburse anywhere around 75-80 lakh rupees monthly disbursement. As they go to the next level between 1 to 3 years, they stabilize anywhere between 1.1 crores of monthly disbursement. And once they stabilize, which took almost 3 years, they crosses the number of around 1.2 CR monthly. This is the way the branch works on that piece. And instead of focusing more on what is the AUM they produce, we always focus on what is the capacity branch can run with in terms of getting a new acquisition, new customer month on month. Our expectation from any average branches, they should disburse at least 10 units in a month, basically, on the disbursement side. And a good, decent branch should cost 12, 13. And once branch reaches to a stable number of 17, 18 units, then it's a peak time for the branch. And beyond that, we try to fragment a branch and open a nearby branch to this existing branch to give a more penetration in that market and get a more use from that market. This is the way largely the operation operates on that side.
Understood. And so if we exceed 17, 18 units per month, we try to divide the branch into 2 teams, correct?
Yes. So what we do, for example, there's a branch in one geography and demand is coming very high. then we see in the nearby vicinity, maybe 40 kilometers or 50 kilometers away from that branch, we come with a new setup. So this way, we meet the requirement, demand of the market there, as well as what you said, the processing activity is also being diverted in such a fashion. So there is not a burden on one single branch for a heavy processing side, because in any branch we'll have a one operation executive or credit manager.
Understood. And so just the last couple of questions. So we disbursed close to 828 crores this quarter. What would be the split across our three vintages of branches, year 1, year between 1 to 3 and more than 3?
So largely in this quarter, we have sourced monthly 3,000 fresh customers, if you talk about, which we added there basically. If you talk about on the vintage side, since our more than 3 years branches are 126, so major ratios, which is almost 60% of business comes from them. Then 1 to 3 branches, that will be around 20%, and remaining comes from up to 1 year branches.
Understood. And sir, as on date, if I were to look at the split between employees, what would be, how many RM do we have, how many branch credit officers do we have, and in terms of the central credit team, what is the team size? And sir, an additional question to that will be that when we have a central credit team, what is the capacity of that team that it can do a disbursement per month?
Credit का model
fill करूँ credit का कि first. So every branch we have a dedicated branch credit manager. So today we have 260 branches. Then our credit team across will be more than 260, because some larger branches may have more than one branch credit manager. And same is the number of branch operation executives in each branch. That is one piece. If we talk about centralized team, the centralized team have one dedicated operations team, which is centralized operation team, which process the disbursement when the things happen, and one hindsight team, which are majorly having a role of checking the proposal once they get approved. So this hindsight team constitutes around 19-20 people as such, which are focused on basically verifying all the checks and balances there to maintain what is getting processed from the branch side. Once they give a clearance on the form of sanction, then the role of operation team comes in form of disbursement. That is again a team of around 50 to 60 people which sits in head office to do that process.
So I didn't get how many RMs do you have as on date out of the 3,704 employees that you have?
Almost 1,700 of people are field people. Since we source directly in market, our 98% of sourcing is a direct sourcing. So we have a pretty large people across these 260 branches. So if you take out that average of 4.5, that comes out 1,600 people what that they are spending on.
And sir, are you seeing any increase in competitive intensity in terms of BT outs?
So I think our BT rates are consistent from last 7-8 quarters in a tune of around 6%. That is being maintained even now. This quarter also we maintain the same level approximately.
Understood. That's it from my side. Thank you so much for the opportunity and wishing you and the team all the very best.
Thank you. Participant who wishes to ask a question may press star and 1. The next question is from the line of Renish Bua from ICICI Securities. Please go ahead.
Hi sir, and congrats on a good set of numbers. So just a couple of questions from my side. One on the small ticket LAP loans, right? So I'm referring to slide number 18, wherein we have shared the cuts as per the ticket size. So our less than 5 lakh rupees loan exposure stands at 8%. And I'm assuming this will be the customer segment wherein, some of the customers might be overlapping with the MFI or any other unsecured business loans. So what are the trends in this portfolio, with respect to collection or early buckets TPD?
There's no specific trend in terms of because of a ticket size that is a burning rock. In fact, we have observed in our case, the larger ticket has, shown some stress compared to the smaller ticket size. That is number one. Largely, this is a set of customers which anyway have a collateral which is free from any encumbrance before taking a loan from us. The ticket size is low, but please appreciate where the property values are, where we take a LTV of 40-45% in such kind of customers, is anyway in tune of some 14-15 lakh rupees of property size in those kind of customers. So they have a small business activities. They are largely in Tier 3 market and Tier 4 where we operate into that. But seeing with the lens of MFI is difficult because they are something which have a clear title of the property and they are looking for loans for small activities what they are into basically. In fact, in our case, we found the credit culture in this these kind of customer to be almost at par with what is average tickets of 10 or 12 or 15 lakh rupees of customer.
Got it. And in general, let's say 40% of our LAP portfolio is also behaving in a similar manner how HL portfolio is behaving?
LAP portfolio have little higher delinquency than HL portfolio, if you ask me. That is the trend which I have seen currently. But this we have seen because of multiple seasonality factor also. Because H1 have a that seasonal factor, which generally impact more on the LAP customer than the HL side, basically. That has been seen. Now, as seasons get staged, festivities start bringing up, they start, getting a business activities done. The trends also seem, changing across. Because same was the trend last year, same was the trend last year also, typically in this time of things. So LAP have this kind of distinction when you do it, basically. There will be always a gap of some, bits between LAP and HL in that case.
Got it. So there is, there is no sign of any stress build-up or anything in LAP as such.
So I won't say it is because LAP or because HL as a, product per se. But yes, currently if you say we require more efforts to do the collection, this has been a trend which has been observed and which we are also keep discussing whenever we, chat around this piece particularly. But good part is now LTV is comfortable here. So there's always a propensity to cover it quicker than the HL customer in many cases.
Got it. And so just last question on the yield side, right? So we have been sort of sustaining this 15% odd yields. How confident we are about sustenance of this kind of a yield going forward, given now, our base is also relatively higher, let's say a year back?
So, Ranishji, we always believe in maintaining the spread of 6%, basically, right? Okay. So that's prerogative. We are maintaining 6.1. So I think if there's the benefit of cost of fund in future, then definitely we would like to pass on to this customer. So these are the levers which we have to keep, operating as we keep growing the operation. But yes, I think as you're going more into Tier 2, Tier 3 markets, beyond Tier 3, Tier 4 markets, there is always a scope of sustainability with these kind of yields. That is the answer which you might be looking for.
Got it. Follow up on that. So I'm just asking because since we run a pretty large fixed rate book, right, and hence if one is to assume a rate cut maybe over next 6 to 8 months, so ideally we will be in a better position to sustain yields as compared to industry, right? And hence our spread could be higher than the, let's say, the guidance range of 6%. I mean, is that the fair assumption?
So, near term? For some time, yes. Once this transition is happening, definitely that will be, benefit for some time because there's a transition time in that terms. So you'll always feel that the margins what we're maintaining, there'll be objective little improvement in that sense because you get a benefit of cost cut there basically. Right, but overall, as we progress, we'd always like to, take that advantage to give back to the customer in terms of maintaining those spreads.
Got it. Okay, that's it, sir. Thank you and best of luck, sir.
Thank you.
Thank you. The next question is from the line of Aditya Pal from MSA Capital Partners. Please go ahead.
Thank you again for the
wanted to double click on the previous participant's question. So this 1.2% of stage 3 assets, what would be the split between our home loans as well as the loan against property product?
Normally we don't split in these kind of piece, but yes, if you want, because just we come out the result. But I think it will be between 1.1, 1.15 would be HL, and 1.35, 1.4 would be the LAP. That is my understanding on that piece. But the exact numbers you want, we'll give it.
And this and also by going a bit more granular, So in Madhya Pradesh, the pain point is coming more for lab customers or more for HL customers?
Both sides. It is not
Both
because
sides.
of some customer side, it is because of our propensity to execute in that.
And so it's a more macro related issue?
It's more on the operational side that we have to activate ourselves. There are some changes which we built up, and that result is yet to come around that side.
Understood. And sir, a broader question would be, you highlighted this in your opening remark. So RBI is come a bit strong on at least the unsecured lending space. Do you see, and more importantly, there is a visible slowdown as well in the macro scenario when we look from the consumption perspective. Do you see any instances of our disbursement growth slowing down from here?
I think if you see the affordable housing, particularly when we talk about India Shelter, 18 to 20% are new to credit also. That's the kind of customer that we fund into. And this set of customer, they prepare to take this loan not a month or 2 months back, but they have this wish or dream to have the home. And they keep building their equity base till the time they reach that point. And once they decide to take this property, which they call home, they look for a support in terms of home loan from the companies like us. So when we are maintaining the LTVs of 55-60%, which means there's a lot of say from customer side in terms of equity infusion there, basically. So largely it is not a matter within a month or 2 months they will, divert from their plans or things around that piece. So I don't think unsecured plays any role in the growth trajectory or in, tapering the growth in the home loan market per se.
Correct.
Segment altogether. This is altogether different segment. They behave independent to each other. Yes, overall financial institution are considered keeping these products under single basket. That is there. Rest of things are not being linked to that extent.
Correct. No, because I completely understand that you're very well capitalized to achieve this growth rate, but more importantly, the demand is not going down. That you're seeing on the ground.
Not exactly. Demand is not going down. That is, in fact, this quarter, this has been the highest ever disbursement.
Correct.
For many of the housing finance companies, including it.
Understood. Fair enough. Thank you so much, sir. Thank you so much again.
Thank you. Participant who wishes to ask a question may press star and 1. The next question is from the line of Omkar Panchal, an individual investor. Please go ahead.
Thank you for taking my question. What I wanted to first ask was the split between the self-employed customer. So what is the split between self-employed non-professional and self-employed professional?
We hardly have a self-employed professional. We are actually catering to the set of customers when they are not normally a part of larger financial institution. They have a small business activity in Tier 2, Tier 3 market. And to fulfill the dream of having their own homes, we are there to support them. That is the first thought on which we work around, basically. So self-employed professionals we talk about, they are being catered by the prime customer in the prime markets. In this category of customers you deal, they are on the outskirts of, larger periphery. So you'll not find self-employed professionals around that side. We hardly have anyone.
Okay. And with respect to branch expansion and your strategy, so what I can see from your branch expansion from March to now, most of the branches that have been opened are in Rajasthan, Maharashtra, Uttar Pradesh, these places. So are we concentrating on the north and western region, or are we going to be spread out across states? How is that looking?
We have more than 40 branches in south. And that they are giving, they are coming out in a very promising way. And both numbers, growth-wise and everything is giving a very good output in that sense. So we don't have this concept that we have to be north-based or west-based. We feel that we have to have our strong distribution presence across country that we are driving around basically. And we are getting results around that side.
Understood. But are we focusing on any specific reason or just going to be broad-based across wherever we see opportunities? Because
opportunities are there. Wherever we find, that is always there. We definitely do some market study, understanding whether it's a viable to open branch as of now immediately, or we'll have to take some time around. Those things are internal strategic point. But for wherever the opportunities are in 15 states, we are not expanding beyond this 15 states as of now, but we look forward. Am I able to answer the question?
No. So what I wanted to understand was, are we going into areas, for example, in Rajasthan, the 7 branches that we added, were they deeper expansion branches, or were they new locations in areas where competition was not there, or we are in competition with others? That is what I was trying to understand. The broad-based expansion that is going to happen, is that going to be focused on new areas or competing areas?
So largely where the mortgage possibility is, where the market gets response. That is the first and primary focus. Again, the structure is largely been created among these 15 states so that we don't have much of logistics challenge. We see that market has been tested already in terms of vicinity of already existing branch. That always give a more comfort in that sense basically. So we evaluate those markets and accordingly we open. So we don't distinguish that we have to capture certain market as only Rajasthan or North or only South or West. That is not the game plan altogether. It is altogether where we find the opportunity in the areas of operation we already exist. We try to experiment ourselves.
Understood. And finally, on the OPEX to AUM, where do you see that? Because if we say that we are going to add 40 to 45 branches every year, where do you see it stabilizing over the next 2-3 quarters, 4 quarters down the line?
So every year we are adding 40-42 branches. Earlier the base was small, on which we are adding 40-42 branches. So a year back we were adding, say, on maybe 180 we are adding 40-42 branches. This year we are adding on the 220 the 40-42 branches. Next year again the 265 numbers will be adding on this piece. So as the base is growing, which means this is going to taper down when you talk about Apex particularly, because the major investments are already gone into the structures and things around that piece. So you can easily see every year on year, you can find 20-25 bits of OPEX support into that side. So we started this year at probably 4.5, and you can see easily coming up to 4.25 as we close the year.
4.25, sorry? What was that?
So you can, we stand today 4.4. You can see it's coming down to some 4.25 as we close this financial year.
Okay. Thank you.
Participants who wishes to ask a question may press star and 1. The next question is from the line of Manav, an individual investor. Please go ahead.
Sir, what do you think about the ROE number shaping up for the next 3-4 quarters?
Manavji, we raised equity in December 2023. Because of that, our leverage today is quite low. We are having a leverage of around 2.6. We are going at a rate of 30-35%. So at a closure of quarter 4 last year, we were at 13.8. Previous quarter, we were at 14.3. Today, as we closed September number, we are 14.8%. I think this is going to be definitely an improvement if that is there. But if you talk about next 4 quarter or maybe something like that, you'll find it is going by, quarter on quarter, maybe some 10-15 dips. Improvement is quarter on quarter. You can then make it off basically. So this is the game which has to play a little long. So what we see the long horizon of 2 to 3 years. If once we see that level with the leverage which is touching 4.5%, almost same number which is coming around the ROAs, you can expect that time from 16.5-17%.
Okay, sir. And for the disbursements, any guidance?
So you can assume we look forward 30-35% of annual growth on the EM side. So that is something we should look forward.
Okay, sir. Thank you so much.
Thank you. The next question is from the line of Ajish JL, an individual from the company of Investor Things. Please go ahead.
Hi, sir. Am I audible?
Yes.
Okay. Anyway, congratulations on the good set of numbers. सर मेरा क्वेश्चन है कि ये हाउसिंग फाइनेंस सेक्टर में, अफोर्डेबल हाउसिंग फाइनेंस सेक्टर में लॉन्ग टर्म में हमारा रिस्क क्या क्या आ सकता है? जैसे अभी माइक्रो फाइनेंस में अभी थोड़ा बहुत रिस्क हमको दिख रहा है, तो लॉन्ग टर्म में अफोर्डेबल हाउसिंग फाइनेंस में क्या क्या रिस्क आ सकता है?
Is biggest which can up, the demand is not coming from market. That is which I don't think it is going to come very soon. At least not for next 3, 4, 5 years. Demand is picking up. Typically, the kind of products and some kind of segment is affordable, which is quite advanced. Anyway, when demand is not anywhere for the business, that can be long-term risk. Second risk, the liability side. Once you reach certain scale, how you can support in life. That is the biggest risk. And third risk is the people risk, which is always there in any kind of large operation setup which is there. These are the important risks which can come around. Otherwise, if you are prudent in terms of corporate governance, taking the regulations, know how very well while operating it, you should not worry about because this business actually have a lot of longevity around that side.
ओके सर. और आरबीआई के साइड से रेट कट वगैरह आ गया तो ये हमारा कंपनी को कैसे इम्पैक्ट करेगा?
सॉरी, कम अगेन.
रेट कट वगैरह हो गया तो इंडिया स्पेसिफिकली आरबीआई के साइड में रेट कट हो गया तो हमारा कंपनी को कैसे इम्पैक्ट करेगा?
कॉस्ट ऑफ फंड नीचे आएगा, दैट विल बी पॉजिटिव इम्पैक्ट सर.
ओके. और आगे 5 साल के बाद आप कंपनी को कहाँ देखना चाह रहे हो, मतलब इन टर्म्स ऑफ AUM?
So if we grow by rate of 30-35% for next 5 years, this AUM can actually go to anywhere beyond 3,000 crores.
Okay, sir. Thank you. That's all.
Thank you. The next question is from the line of Omkar Panchal, an individual investor. Please go ahead.
Hello. Thank you for the follow-up. So currently we have a monthly run rate of 270 odd crore. How long do you think that will it take for us to reach say 300 crores? And how are we thinking to scale it up? That is the first one.
So we have 2 major levers. One is the productivity on the ground for the existing branches which we open. So every year since we are adding 40-42 branches, the productivity is going up, as we mentioned earlier also, that every year there's an improvement in productivity in such branches when they start stabilizing. So there is a big gear to it, and definitely there's we have planned to open for next few years 40 branches year on year. That's the other lever which is going to affect us. So last quarter the productivity was in tune of around 250-255. This quarter it is 270. So we would like to catch up as the least possible on that side also.
Okay. Is it possible for you to share what is the per employee productivity or maybe per branch productivity, the number of files that you do?
So monthly, if you talk about per branch, the number of customers which are being approached for the loan are around 25 to 30 customers that comes for the looking for loan with us. What we are able to typically disburse is 10 to 11 units per branch in a month basically. These are the 2 important parameters that we work and judge on terms of what is the output coming around. So I think that gives you some idea that exactly how this productive drive happens. In any given branch, there are 3 to 4 average loan officers with 1 branch manager and 1 credit manager and operation manager. This is the team size in the branch.
Understood. So approximately 50% conversion rate will be correct to understand. 50% conversion of approach to so login to sanction is effectively what you are saying.
Little less than 50%. So it is not touching properly 15%, but it is around that.
Okay. And with respect to credit cost, the credit costs have more or less been stable at 40 bits, 50 bits. Do we see it continuing for the same over the next 2-3 years, or will it drop?
So that is our prerogative. That is we keep striving and driving around that side. That we want to maintain it.
Okay, so the credit cost will remain at 40 to 50 bits over the next, say, 2 years. Will that be fair?
Yes, that is the thought all about.
Understood.
Thank you. As there are no further questions, I would now like to hand the conference over to Mr. Rupinder Singh for closing comments. Please go ahead.
Thank you everyone for taking your valuable time for attending our earnings call. We will keep you posted for any further updates. Also, an audio recording and transcript of this call will be uploaded on our website in due course. Looking forward to hosting you all in the next quarter. If you have any further questions or require additional information, please feel free to reach out to us. Wishing you all a happy and prosperous Diwali in advance. Thank you so much.
Thank you. On behalf of ICICI Securities, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.